Alright, so we are now done with the base cost side of things, and we're now going to be moving on to the proceeds side of things. Remember, every transaction, asset disposed of, proceeds, and base cost. So, yes, proceeds is where we're now moving to, paragraphs 35 to 43, and the general rule is just as follows. Your proceeds will be any amounts received or accrued or treated as being received or accrued in respect of the disposal. Could be in cash, could be in jelly beans. You've got all the normal things about what it is. Just remember, gross income, everything other than capital, everything which is capital, which will go into your proceeds here. That's your section, para 35, general. The following amounts are expressly included, okay? The amount by which any debt owed by a person has been reduced or discharged. This is the other side of things. Okay, so with debt reduction, with your base cost, that is when your debt is forgiven and you don't have to pay. Here is what you are speaking about, where you are the person forgiving the debt. Okay, so that has to go in. Any amount received by or accrued to a lessee from the lessor related to improvements to a leased property, those will have to be proceeds as defined, okay, as well as anything in terms of a value shifting arrangement. I wouldn't stress about that. So the following amounts are expressly excluded, okay, and the first one is the one that we've done before. It says any amounts taken into account when determining a person's taxable income for normal tax purposes, i.e. a recoupment. So any amount which is included or is going to be included in taxable income is taken out of proceeds. The best example is always a recoupment, and even a deferred recoupment. It's all of the amounts that are going to go in, not just the amount in the current year. Okay. Also, remember VAT. If you're receiving money and you're receiving VAT, the VAT portion isn't yours, so you don't have to worry about it. And if any amount becomes cancelled or is repayable, as in Part B or similar to C, they are not going to form part of proceeds. Okay, very simple example here. I think you can take a bit of time to just pause and have a look at it. I don't need to speak about it in any more detail. Good news, ignore para 35 cap A, 36 and 37, but you'll notice that I don't say anything about para 35, if I remember right. I'm getting a bit confused here. That's because para 35 is just your general rule. You only get to ignore para 35 cap A. We then get to para 38, and this is something that I'm hoping you've thought about already and you've actually dealt with a little bit. But what para 38 says, any disposals or donations not at arm's length or to a connected person. You are deemed to have disposed of that asset at market value. Okay, so any asset which is donated is sold for consideration not measurable in money, so like for a hug, or to a connected person at less than market value, you have to treat it as being you sell it at market value and the other person buys it at market value. Okay. Para 67 overrides certain other rules, so just be aware of that. Okay. But para 67 we'll come to later. Para 67 speaks about transactions between spouses. All right, the numbers change, so don't stress about that, but the process is the same. It overrides this, but in general, any donation or disposal to a connected person is going to be at market value. We'll come back to 67 later. At the same time, any disposal to a connected person is going to be deemed to be at market value as proceeds the other person acquires at market value. But at the same time, if you make a capital loss on any disposal to a connected person, you have to disregard that capital loss. You can keep the gain, but you can't have the loss. That loss, however, is not gone forever. Okay, it can be set off against any future gains from the same connected person. Some stuff to remember: they can be connected just before the transaction or just after the transaction if the transaction in some way affects whether they are connected persons or not. Okay, and it's not permanently disregarded. It can be set off against the same person in future. The words you'll sometimes see is ring-fenced, or I hate this word, but clogged. I don't really know what it means, but people use it. So it's ring-fenced or clogged. As you see here, you can set it off against the same connected person in the future if you make a gain with them. If that person is no longer connected when you make that next disposal, it's permanently lost forever. Okay, so if they're no longer a connected person, then you just lose out on the capital loss that you have. Okay. Some other cool sections. Section 24M speaks about unquantified amounts. Okay. So when the consideration is not quantifiable on the date of acquisition or disposal, this technically is not found in the 8th schedule. It's section 24 in the Income Tax Act. Okay. Any incurral or accrual is deferred until the full amount becomes quantifiable. 24M doesn't change the nature of whether it's income or capital. It just says that, hey, if you haven't yet actually determined what all the proceeds are going to be, you can't have a capital loss until you've actually got all of your proceeds. Okay, that's what paragraph 39 says. It's very similar to 24. It's where you dispose of assets for unaccrued amounts of proceeds. So you sell an asset, but only some portion of the proceeds accrue. Some of it may accrue later. You may not know what some of it is. You have to disregard any loss until the full proceeds have accrued. Okay. If you're certain nothing more is coming, then you may actually count the loss in the current year. Why we have this is because you could have a scenario where you say, I'm selling this asset for R1 today and R1,000,000 on a possibility in 400 years' time. Right now, you're going to have a huge capital loss, and you're only going to have a capital gain in 400 years' time, maybe. SARS isn't going to let you have that capital loss now, based on the assumption that there's still proceeds coming way in the future. Cool. Here's an example, okay, about what happens when you dispose of a depreciable asset between connected persons. The key thing here is that it's depreciable, so there's going to be some kind of a write-down. I don't think it's a very tough example, but please have a look at it and make sure you understand it. This example just speaks about a disposal to a connected person, so deeming things to be at market value and how you treat the future set-off of any capital losses to a connected person. Some more good news. You can ignore 40, 41, 42, 43A, and 43B, but you can't ignore paragraph 43. You can ignore 43 cap A, but not 43 itself. Paragraph 43 speaks about how you treat assets which are sold or bought in foreign currencies, but good news for you, we will do that in GDA. You still need to know how foreign currencies work. Okay, you still need to know the basics of if you bought it in a foreign currency, you treat it at spot rate. But this is speaking more about situations where you're buying it and selling it in different foreign currencies, different years over different periods. We have to know how to treat normal spot purchase, spot sale. This is when we get a little bit more complex with multiple currencies, some in rands, some in foreign, stuff like that. Great. Proceeds, probably quite a bit easier than base cost. I think base cost is where you're going to have most of your trouble. Then we move into the sections about exclusions, rollover, and attributions. These are sections that in some way generally reduce your CGT or help you to postpone your CGT to a later period. The first one we're going to look at is exclusions, and the most obvious one that you've done before is your primary residence exclusion. Key things here: primary residence, the main place in which you live. It is only for natural persons because a company doesn't live anywhere. Okay, so in para 44 you're going to find the definition of primary residence, and you're going to see that it is defined as where a natural person, okay, holds an interest, and that person or one of their beneficiaries, okay, of a special trust, or a spouse of that person. So if you or your spouse live there, and you ordinarily reside there as your main residence, and it's used mainly for domestic purposes. So you have to ordinarily reside there. Think of ordinary residence. That needs to be your place where you return, and at least 50% of that, okay, or more than 50 because it says mainly, need to be used as a house. You can't have a factory. You say you live in 10% of it, therefore that's your house. It has to be used mainly for domestic purposes. A residence here can include any kind of structure, a boat, a caravan, or a mobile home, as well as anything attached to them. Okay, so it doesn't just have to be a house. Could be a boat, could be a caravan. And if it is deemed to be your primary residence, what you can do is the following. Two options. If your proceeds are less than 2 million, you ignore any capital gain. Still possible you can have a capital loss, but you ignore any capital gain if the proceeds are less than 2 million. You cannot use this top one if you haven't continually resided in the property since 2001. That doesn't mean you have to have owned it since 2001. What it's saying is, for whatever period you have owned it since 2001, you have to have lived continuously in it. You can't, have lived in it for 6 months, gone to another house, lived there for 6 months, come back. This means you have to have stayed in it for whatever period you owned it. Also, you can't apply this top exemption if it's used partially for trade. So this is called the gross exclusion. If profit proceeds less than 2 mil, ignore any gain, you can still have a loss. If, however, any other scenario applies, what you do is you ignore 2 million of any gain or of any loss. So if you don't qualify for above, you exclude 2 million of any gain or of any loss. As the name implies, this is your primary residence, so you can only have one at a time. You can't have multiple residences at a time. So a basic example here, just think about what percentage of it is domestic. Take a pause, read through it, shouldn't have any problems. But now we start getting to the complex side of things. You wouldn't have dealt with this in your previous tax course, but in tax 3, what you need to start thinking about now is there are going to be certain circumstances where how you apply this 2 million is going to be important. And I'm going to make this big because whenever I do this, something important is being said. You never, ever, ever, ever apportion the 2 million exclusion. That always stays 2 million. What you do need to apportion is what that 2 million can apply to. You can only ever apply that 2 million to the primary residence portion of the house. What this means, if you are using part of the house for trade and part for primary residence, the primary residence exclusion stays at 2 mil, but it can only apply against the portion of the gain that relates to the primary residence. It can't apply against the portion that relates to trade. And what we're going to look at in this list that is coming up is going to tell you what you can apply that primary residence to. It's not going to apportion the primary residence or the primary exclusion itself. So what it says here, para 46 speaks about the size of the property. So you can only apply the 2 million to the actual house and the first 2 hectares of size around the property. So if you've got a massive farm, you can't apply the 2 million to the entire huge farm. You can only apply it to the portion that relates to the house and 2 hectares around the house. Anything more, you're going to have to apportion and not apply the 2 million to that. The next paragraph is paragraph 47, and that speaks about periods where you didn't stay in the house the entire time, but I think I don't have enough time left to get into that properly, so I'm going to save that for the next video.